Hi, I'm Ross Mayfield, investment strategy analyst at Baird. While the first half of 2023 was undoubtedly better than many expected, it was not without its challenges along the way, from a banking crisis to debt ceiling turmoil and many things in between. So as we head into the second half of the year, I'm thrilled to be able to present a Q&A with Strategas, a Baird company president and head of portfolio strategy, Nicholas Bohnsack. In this brief video, Nick is going to touch on all things interest rates, inflation, earnings, and ultimately how the firm is positioning client portfolios for the second half of 2023. So without further ado, I'd like to present Strategas President Nicholas Bohnsack.
What is Strategas' economic outlook for the remainder of 2023?
Yeah, the U.S. economy is clearly under some very acute pressures from a number of different sectors, and not the least of which has been the dramatic tightening of monetary policy over the last 15 months. And the cost of tightening monetary policy to the extent to which we have has historically elicited a slowdown in economic activity. What's been interesting in the most recent episode has been the resiliency of the U.S. consumer by way of the strength in the labor market, and of course, more directly, the general strength of the stock market. At the same time, when we look under the hood at the data, particularly earnings and interest rates, it's very difficult to look past the idea that the economy is likely to slow further from where it is today and into recession as we look out toward the end of 2023 and the beginning of 2024.
How do you see the path of inflation and interest rates unfolding from here?
Yeah, inflation has been the Scrooge that keeps taking from this economy, and it's very clear that policymakers, particularly the Federal Reserve, but global central banks in general, look at the landscape and have decided that the policy error is not pushing the economy into recession, but rather allowing inflation to become unanchored. So on the one hand, while we've had very aggressive tightening campaigns globally as well as we've seen here in the United States, and headline inflation has come decidedly lower from where it was at its peak last summer, some of the stickier elements, particularly wages and rents, remain rather elevated. And the chairman of the Federal Reserve here in the United States has indicated that the Fed's proclivities will be to likely tighten further. So it's very likely that in a short course, short rates are going to move higher. That leaves a lot of volatility attendant in the fixed income markets as we look out really through the end of the summer and perhaps the beginning of fall. But it's our suspicion that we're closer to the end of this tightening campaign than the beginning. So we should see a steadying and leveling out of interest rates as we move toward year end. And with it, inflation will likely start to come under some of the acute pressures that tightening bear, which is to say, start to moderate, albeit at a slightly higher level than it's existed historically.
What are your expectations for corporate earnings and profit margins?
Well, one of the really interesting aspects has been the resiliency of the labor market. And so that has, just by Dane of the flow through, has led to slightly stronger consumer and slightly stronger economic growth, but is also, as sales have softened, has led to a little bit of pressure on profit margins. And so we've seen a flattening out of profit margins in the aggregate since the fall of last year in the third quarter. And it's expected that they will continue to come under some pressure as we move through the year end and into next year. The consensus is a little bit more optimistic on profit margins than we are here at Strategas. And generally speaking, if recession is the base case, we would anticipate there to be a greater drawdown in corporate profits than perhaps the market and their optimism has baked in.
How are you positioning portfolios for such an environment?
It's very tempting to want to get long this stock market when you come in every day and it seems like it's going up. But it's very important in our view to remember that the stock market was flat heading into some of the regional bank failures that we saw earlier this year. And almost all of the market's performance has really come on the heels of that, when I think it became clear that policymakers were willing to step into the void to avoid another systemic crisis. So as we move into the summer and look out towards the year end, our proclivity has been to become somewhat cautious on the market. We've maintained that positioning really for the better part of the last 9 months, and at times that's made us look wrong. But we favor value over growth if we think about slowing economic conditions, and particularly given likely slightly higher interest rates. A lot of the growth stocks that have done particularly well to start the year has been driven by very narrow leadership focused on Fang and Friends and artificial intelligence, and those are certainly pockets of opportunity. But if we think about one sector that has showcased its resiliency perhaps above all others, it would be the industrials. Tried and true operators that have existed over long periods of time through multiple business cycles, willing and able to sort of adjust to the different operating environments, but ultimately at the underpinnings of the global economy. When other things do well for brief periods of time and industrials takes up the mantle, it's suggestive of an economy that may muddle through, but also is looking for opportunity. So we'd think highly about taking a second look at industrials, even against the backdrop of a more cautious outlook.
What could change your mind on your market and economic outlook?
Though we remain cautious and suspicious of the economy to follow through, certain pockets like industrials and labor have certainly led to a stronger economic result in the first half of this year than we would have anticipated coming into the year. To the extent to which the Federal Reserve has indicated that we're closer to the end of their tightening campaign, and the belief perhaps that inflation has been wrestled back to an acceptable level both to consumer investors as well as policymakers, the follow-through on the corporate earnings side would certainly have to be taken as a bullish indication for a new economic cycle. Ultimately, and somewhat in contrast to what we've experienced over the last 10 years, this next business cycle will very likely have to be sustained by organic drivers of growth, strong enough to call capital in from corporate operators looking to expand their franchises, and enticing enough for investors looking for returns in an otherwise difficult market, but one increasingly with other opportunities for risk-safe returns. As always, thank you for taking the time. You can be sure here at Strategas we'll keep our eyes on the data, but wherever the Baird team can be helpful, please reach out and let us know.